My name is Carl Greenfield, one of the lead authors of the report. Today I'm joined by Timur Gul, our Chief Energy Technology Officer, as well as Mathilde Fajardi, the other lead author of the report. I'll briefly begin by outlining how the next hour will run. First, we'll hear opening remarks from Dr. Gul, followed by a presentation of the report's key findings by Dr. Fajardi. We'll move into a moderated panel discussion where we'll hear our distinguished guests give their expert perspectives. Then we'll open it up to questions. First, a couple housekeeping points. First, this session is being recorded and will be uploaded to the IEA website for later viewing. And second, you can submit questions via the chats. We'll select some questions from the audience at the end during the panel Q&A. Dr. Gul, over to you.
Thank you, Carl. Good morning, good afternoon, everyone, depending on from where you are listening to us. Thank you for tuning in today for this launch event for our new IEA report on CCUS called Financing CCUS at Scale, How to Mobilize Private Capital. My name is Timur Gul, as Carl already said. I'm IEA's Chief Energy Technology Officer and in charge of the energy technology team here at the IEA that has produced this particular report. Now, for those who are following energy a long time, as I am, CCUS has been recognized as an important suite of emission reduction technologies for a very, very long time. Many countries have been supporting that case. Many industries have been operating in this space for a long time. But actual deployment has really been modest. In particular, I'd say after that initial boom that we saw around 2010 or so, over the last decade, the deployment, the 2010s, the deployment has been rather modest. The business case, of course, for CCUS is very challenging. Capturing CO2 and storing it deeply underground for thousands of years just requires a value proposition that is high and that is justifying both the high capital expenses and the long-term liability considerations that come with CCUS. But there's reason for hope. The more than 30 projects that have reached a final investment decision in the past 2 years suggest some degree of improvement. We are tracking those projects on our website every year. My two colleagues here, Carl and Mathilde, have been doing excellent work here in this space. And this in some ways sets the stage for a potential step change in CCUS deployment. To give you a sense here, if all projects under construction today would successfully move into operation, then CCUS capacity would nearly double by the end of this decade compared to where we are today. So a really significant potential for improvement, and I know Mathilde will talk a bit more about that. But making a business case, a clear business case here is a tough challenge. Without the right investment conditions and stronger approaches to sharing risks, making that business case to advance progress beyond the recent projects that we've seen may prove to be very difficult. This is where today's report comes in. The questions we asked ourselves for this particular report that we are presenting today are: how can governments and financial institutions help create the right conditions to move more CCUS projects to operation? What are the risks that projects face, and how can we manage and allocate them effectively? And of course, does this differ by region? Is every CCUS project the same, or does it change depending on the regional circumstances? We did not develop this report here just at the IEA by ourselves, but we drew on a series of consultations with a dozen financial institutions and evidence from recent final investment decisions to identify where bottlenecks persist and to set out a clear agenda for improving the financial conditions that are needed to support the next generation of CCUS projects. Before closing, let me thank all the contributors to this report across governments, financial institutions, and industry for their critical input and feedback into this analysis. In particular, I would like to thank our three panelists today who, in addition to providing expert guidance and review to this report, will give their perspective later today. These are Alan Baker from Societe Generale, Mayam Golnaragi from Geneva Association, and of course, my good friend Pradeep Tarakan from the Asian Development Bank. So without further ado, let me hand over to one of our lead authors here, Mathilde Fajardi, who will take you through the report's main findings. Over to you, Mathilde.
Thank you. Good morning, good afternoon, and good evening, everyone. I'm Mathilde Fajardi, and I'm delighted to introduce our new International Energy Agency report on financing carbon capture, utilization, and storage. CCUS has long been recognized as essential to achieving climate goals, but as Timo was saying, progress on the ground has not kept pace with ambition. And a key reason for that is the persistent challenge of financing. So today I'll walk you through how this report addresses these challenges, drawing on real-world experience to propose concrete actions governments can take to mobilize private capital into the sector. And so starting where we are today, growth in CCUS capacity has been steady but relatively limited in the last 2 decades, standing around 60 million tons of CO2 captured or stored today. And this is really the result of several waves of investment. First, in the early 2010s, where CCUS was poised for a major expansion as a result of public support packages to address the financial crises, but where in the end, few projects actually reached commissioning after several countries pulled out their support. And then a second wave after 2020, investment began to pick up again, driven in part by growing corporate climate commitments. But this second wave is actually much larger than before, as a lot of that investment has yet to materialize in operational capture capacity and storage capacity. In just the past 2 years, we've seen over 30 final investment decisions, and as a result, there is now roughly as much capacity under construction as is currently in operation. So what this means is that after years of incremental progress, there could be a step change in deployment for CCUS. And in addition to being larger than before, this wave is also a lot more diversified by sector. And we've seen projects, final investment decisions in hard-to-abate industry, particularly cement, in hydrogen-based fuels, in large-scale carbon removal, and in the development of dedicated CO2 transport and storage infrastructure. And really at levels that were not seen previously. And there's even more projects in the pipeline. At the IEA, we track all projects at different stages of development. We've just released the update of the IEA CCUS projects database, which is available on our website. And we see that 90% of these projects have yet to reach a final investment decision, which really raises the question, how can governments and financial institutions help create the right conditions for these projects, to move these projects into operation? CCUS projects are inherently complex, they're difficult to finance and exposed to unique risks. The CCUS value chain brings together multiple technologies on capture, transport, and storage. It also brings together multiple regulatory systems and commercial actors, each with distinct risk profiles. But really at the core of CCUS, the challenge is commercial viability. And like other clean tech, CCUS manages CO2, carbon dioxide. This is a product with little intrinsic market value and limited demand. This creates significant revenue uncertainty throughout the value chain, and each segment therefore rely on different yet often fragile business models. And on top of these fundamental challenges, there are distinct risks that come into play when it comes to delivering a CCUS project altogether. First, on the policy side, when business models rely almost exclusively on policy support, a change in policy can pose significant threats, which can be difficult for investors and lenders. Construction, operation, and performance, like all major infrastructure projects, there are inherent risks around these aspects, which a lot of financiers are used to, but these are made more acute by the limited track record of CCUS. That track record is growing. We have now more than 9,000 kilometers of CO2 pipelines operating. We have 70 large-scale capture facilities in operation, but many of these projects remain relatively bespoke. And some of these risks that we're seeing have limited real-world precedents. One of these risks is tied to the long-term liability for stored CO2 underground. And this really is the point that raises the question about how risks should be allocated and insured over time. And finally, cross-chain risks. We know that a chain is as fragile as its weakest link. And as we have business models developed around hubs where project developers need to coordinate capture, transport infrastructure, storage sites through that connected value chain, creating those complex contractual relationships. And all these factors complicate risk assessment and financing. Importantly, we're seeing that public funding has played a critical role and continues to play a critical role in pushing CCUS projects into deployment. In the past years, we've seen a record amount of public funding earmarked for CCUS projects, and we see that this is starting to help catalyze private capital, particularly in the form of private debt. We've seen more than $15 billion in commercial debt raised over the past 2 years, primarily through a handful of project finance transactions, which is emerging as a model to finance CCUS projects, to preserve capital for firms that develop projects and also to distribute risks. This model of project finance is demanding. It requires very clear contractual frameworks and predictable revenue streams for lenders to be satisfied. And we see that countries with the strongest support have begun to attract more private capital than others. Within those countries, the UK stands out, making a significant share of that total, with a single large-scale financing deal in 2024 exceeding $10 billion. And we have also seen notable transactions in other jurisdictions, such as Sweden and the US, reflecting growing lender appetite when revenue support and risk allocation frameworks are sufficiently robust. These signals are positive. That financing remains highly concentrated in a few jurisdictions and sectors, and the current pipeline of deals is still too limited to really constitute this broad market trend. So really the question is, how can we scale up beyond that that few deals? And this will likely rely on continued government support for emitters to decarbonize. Policy support can take different forms, and we're seeing that this region-to-region variation in how does that support look like has an important impact on the types of projects that get financed and how they end up being financed. To take a few examples, in North America, which today has around 40% of capacity in operation and under construction for CCUS, tax incentives, so tax policies, and existing oil and gas infrastructure and industry is really what's helping some segments move forward commercially. We've seen private capital starting to scale in segments like bioethanol with CCS, where projects can stack incentives with carbon credits. And again, financiers and industry are a little more comfortable with risks in general, thanks to the experience with oil and gas. And this is really quite a departure from the early projects that were heavily funded through grants, as exemplified by the Quest project in Canada and the Power project in Petronova in the US. Outside of these markets of bioethanol and another few markets, financing remains difficult, particularly for higher cost applications such as industry and power. Europe, we're seeing that public funding is really evolving from these large grants to long-term de-risking government frameworks in the form of carbon contracts for difference, risk capping mechanisms, and this is really helping projects move forward. We've seen examples for dedicated transport and storage projects moving forward in Norway, the UK, the Netherlands, large-scale carbon removal projects in Sweden, but also industrial projects in different regions of Europe. And this is really allowing more private capital to flow. Thanks to this shift in support, the region now represents around 12% of global capture capacity and 17% of storage capacity, showing clear acceleration after years of very limited progress. Outside of North America and Europe, projects going ahead remain in large part tied to oil and gas industry, either through state-owned companies like in the Middle East and China, or large private oil and gas sponsors in the Asia Pacific. In all these successful projects, the most critical element remains on how risks are being allocated and mitigated across the value chain. Risk mitigation for CCUS can take multiple forms and operates at different levels. You have public frameworks that can reduce unpriceable tail risks. You have contractual structures that allocate commercial risks along the different project actors. And then you have project design choices that strengthen the confidence in the delivery of the project. What recent CCUS investments show is that partnerships are an effective delivery model for managing project complexity and risks. These can be private partnerships between entities like in North America, where many risks are handled commercially through contractual arrangements, or through public-private partnerships with a varying degree of risk ownership by the government, as we're seeing in Europe. And just to give the example of the UK, which managed to attract the most private debt so far, we see that revenue and policy risks are addressed through long-term contractual arrangements with the state, with carbon contracts for difference-like agreements with the emitter. We have a regulated asset-based model for transport and storage infrastructure, combined with changing law protections that improve lender confidence. Construction, operation, and performance risks are allocated contractually among the sponsors, but they're not borne by a single entity. And finally, and really most importantly, these contracts with governments cover a significant backstop to cross-chain risks across the value chain and long-term liabilities, which is unprecedented for CCUS. And so to conclude and leave you with a set of recommendations, scaling CCUS will require aligning business models, policy frameworks, and financial structures. We consulted financial institutions on what could be the lessons learned from recent financing, and we've come up with a few actions that government can take today to strengthen project bankability. And so just to unpack a few, supporting bankable business models and viable risk-sharing mechanisms, this remains the single most important lever to attract private capital. This can be done through stable carbon pricing, support for low emissions products, targeted instruments such as contracts for difference or tax credits, and again, clear risk allocation among stakeholders is the most essential. Some risks, such as long-term storage liability, are likely to require ongoing public backstops in some jurisdictions. Strengthen risk assessment through data sharing. Operational data is quite critical for financiers and insurers, and governments have a role to play in arbitrating that data sharing effort from publicly funded projects to improve transparency. And in that theme, early collaboration among developers, governments, insurers, for example, can really help support the creation of tailored financial and insurance products. So collaboration and data sharing is really important to get this new field off the ground. And finally, increase development funding resources to assess CO2 storage. The private capital gap is always large at the early stage of the project, where very few investors and lenders have the risk appetite to get involved. Geological storage remains difficult in the sense that site characterization is costly. This is where multilateral development banks and development finance institutions can provide support to unlock private investment, particularly in emerging economies. And with that, I thank you for your attention and hand it over back to my colleague Carl Greenfield for the panel discussion.
Thanks, Mathilde. Financing CCUS projects is clearly a complex and interconnected process, requiring the alignment of a broad set of different stakeholders. And I can't think of any three people better qualified to unpack this complexity than our panelists here today, who I invite to be pulled up on the screen and turn their cameras on at this time. On our panel, we have Alan Baker of Societe Generale, Pradeep Tharakam of the Asian Development Bank, and Mariam Golaragi of the Geneva Association, a commercial lender, a development bank, and an insurer. We'll first start by hearing brief remarks from each panelist, giving us their initial insights on the findings of the reports. Alan, let's start with you, and then we'll move to Pradeep, and then Mariam. Over to you.
Okay, good morning, everybody. And firstly, congratulations on a good report. I think it's a very useful contribution to the debate. I think, from my perspective, one of the positive points that's coming through in the report, and I think is coming through in the market, is the global growth in carbon capture and storage. We've seen the projects in the UK, projects in the US, Trailblazer, get project finance in the last couple of years. But I think the pipeline for transactions is now relatively strong. And the encouraging thing for me as well is that because of the amount of debt that's been raised, $15 billion, 8 billion of that, £8 billion of that was for the UK projects. There's now a pool of financial institutions who have experience in financing carbon capture and storage. They've got those transactions through their credit teams, and they're obviously looking now for the next opportunities. I think the point about government support is a good one. Certainly having advised on Net Zero Teesside Northern Endurance Partnership, those projects wouldn't have got done without the government backstopping, which covered some of the risks that the private sector were not willing to take or not able to take. And that certainly helped to mobilise the financing. So I agree, we need to see that going forward to a certain extent. But to build on the momentum and accelerate in the industry, I think we need to constantly look at the risk allocation, constantly look at how much support we actually need from government, because clearly if we're going to build a large number of these transactions, the government balance sheet in most of the jurisdictions isn't sufficient to support every project. So we need to learn those lessons, pick up the information from existing projects, hopefully see the successful conclusion or construction of the projects that have been financed so far, to provide the confidence to come up with more commercial type debt facilities, which are less reliant on public balance sheet, as I said, public support, so that we can really expand the industry going forward. And I think there is liquidity in the market for that. As I said, there are more than 20 banks, probably close to 30 banks now with carbon capture experience, which wasn't the case 5 years ago. Very few banks, if any, had got real life experience of financing carbon capture. And that's got to be the sort of base that we can use to really push on from here to develop the industry. Probably the other point in terms of government support, really one of the key aspects of that is the policy. And it's a little bit concerning at the moment to see people maybe stepping back a little bit from their targets. So from our perspective, what we've been trying to do is to encourage people to focus on the policy, to remain consistent, and give the message that carbon capture is still a key decarbonisation vector that that is going to receive public support in order to provide the confidence for financial institutions to continue investing. So I'll leave it there for the initial chat.
Thanks. Pradeep, over to you.
Thanks, Carl, and thanks for having me on this panel. Apologies for the strange backdrop. I'm actually sitting in a tent. It is Holy Week here in the Philippines, and we've kind of started off early. So listen, firstly, congratulations on this report. As one expects of the IEA, this was a really balanced report. Typically, when one talks about CCUS, you have people on both sides of the spectrum. You have either people who are believers, who are so excited by the technology options and tend to overestimate and overpromise on the potential. And then you often have people on the other side who believe it's never going to happen. It's one of those opportunities that's always decades out in the future. And I think this report strikes a good balance. As Mathilde said, there was this sort of period of high engagement in 2010, and that's when the ADB actually started to support our clients in the Asia Pacific on CCS. We only had about $50 million of grant money from the UK and from the Global CCS Institute. But with that, we began to do a series of studies, stakeholder engagement, trying to understand the potential. And of course, at that time, we were really focused on the coal-fired power plant sector, and then, of course, the gas power sector, and to some extent on gas processing. And unsurprisingly, we found that gas processing offers the best opportunities. But it was just before its time, and even with grant money, you really couldn't get even a pilot off the ground at that point in time. But I think fast forward to today, there's clearly a lot more interest. We get a lot of inquiries, especially from the industrial sector. But I think just wanted to draw two things from the report that really spoke to me. Is one is the public funding is essential, and where I sit and in developing Asia Pacific, outside of the PRC, there really isn't much public funding going into CCUS. India was the only jurisdiction that recently announced a national program. They've committed about $2 billion over the next 5 years. So that hopefully will move, at least a few projects off the ground. But the rest of the region, Central West Asia, Southeast Asia, there really isn't any public funding available. And that, as we all know, is a big problem, because if you look at all the advanced jurisdictions, huge amounts of public money has gone in, both in terms of upfront grants, concessional loans, guarantees, and in the case of the UK and other jurisdictions, revenue support or annuities. So that's something we'll have to address. The other thing that spoke to me was the role of different kinds of financiers. I think transition finance is one area where, absent a strong carbon price, absent a premium market for which are what's otherwise commodities, you're going to have within the capital stack other kinds of financiers coming in. Bilateral donors would be great, But I think in this current climate, as we can expect, it's not going to be a large source. Philanthropies, corporate social responsibility, other sorts of sort of patient capital will have to play a big role. And we are seeing a little bit of that in European and US markets, but very little in Asia. So I would definitely highlight that as an issue. And I think making the link between CCUS and transition finance, again, which something your report does, is really important. It is a preeminent way of transition finance, and that brings with it issues around taxonomy, the key role of partnerships. These projects don't happen by one stakeholder. And having, I think, good leadership at the firm level, because you really need visionary leaders that can pull together all these different partnerships, different financing challenges, the messaging, the fundraising, while also building a very difficult technical project. So I think good leaders particularly are important. And finally, again, just to reiterate the role of public financing within transition finance. So I think those would be sort of the main key takeaways I see from this report. Let me stop here. Thanks.
The bright blue screens we have here, so it's a nice balance, I think, for this launch. And now I'll pass it over to Miriam. Miriam, thank you very much for joining us in the early hours of your morning or very, very late night. Over to you for your initial thoughts.
Thank you very much. It's absolutely a pleasure to be here. It is about, let's say, 1:32 a.m. in Vancouver, Canada, where I'm dialing in from. But it's a great pleasure. First of all, congratulations for this report. I think it definitely will lead to advancing the dialogue, particularly related to de-risking and raising both public and private finance to scale up CCS. So first of all, one thing I wanted to clarify, I don't represent an insurer, but we are a strategic think tank of the insurance industry. Our members are 90 CEOs of largest insurance and reinsurance companies globally. And when you think about insurers, we are not just about risk identification and underwriting, but also, as you know, insurers are second largest institutional investors globally. So you also need to look at them as potential investors subject to better de-risking of these projects. So the dimension that I will bring to our discussion today is really, and what really resonated with me in this report is some transformative thinking in terms of the role that insurance industry can play by way of de-risking and enabling CCUS scaling. We are currently in the middle of a pilot research and development with Oil and Gas Climate Initiative and Clean Energy Ministerial CCUS, really looking at the very benefits that insurance industry can bring to the table through their risk engineering, underwriting, and even subsequently investment approach to CCUS project. And the key things that really resonated with me, and I'm very interested to further explore that with you in this panel, is first of all, how do we look at the risking of these projects? And part of our work is demonstrating that given the complexity of CCS projects as they're scaling, we need to really adopt a project lifecycle approach for mapping of the untested risk, looking at the stakeholders, their liabilities, contractual agreements, our approach to risk mitigation. And ultimately, all of this is to better de-risk the projects and create innovative risk-sharing mechanisms. And I'm very happy to expand on that. The other element that also resonated is role of public policy. But I think we need to go a bit further. This is not just about government's policies about how they are supporting CCS, but we have to bear in mind that stakeholders that are involved in these complex projects come from different sectors and they are regulated by different regulators. And in fact, misalignment of policies and regulations across sectors that are presented or represented in these complex projects create misalignment in their liability regimes. And subsequently, it's very difficult to align risk perspective and ultimately develop better aligned risk-sharing mechanisms. So let me stop here, but I would love to get in more details about transformative ways that we could be thinking about insurance industries as supporting role, enabling role in scaling up these projects. Thank you.
Thanks very much. And now we'll move on to a more dedicated Q&A part of the panel. And for those of you online, I see you're already submitting questions. Please feel free to continue to submit questions. I'll hand it over to my colleague, Mathilde Fajardi, who will kick us off.
We've heard from commercial banks that revenue uncertainty and question risks are some of the biggest barriers to providing debt for projects, given the recent examples we've seen from the UK Transport and Storage Hubs, HyNet and Northern Endurance Partnership, to the Trailblazers, to pipeline in the US. What conditions do you think must be in place for commercial banks to consistently land in CCUS value chains, and what still holds them back?
I think the revenue certainty point is one clear barrier at the moment, or constraint, and part of the problem of that is that if you're going to set up for example, a transport and storage business like Northern Endurance in the UK, you are essentially spending a huge amount of capital on a very large asset, often oversized compared to the initial emitter that you've got feeding CO2 into that chain. So you have the challenge of a startup industry backed by policy, but without the maturity and the volumes of CO2 that you need to provide you with the kind of risk mitigation that comes through diversification of emitters. And on the revenue side, obviously there is support, there's subsidies for capturing the CO2. So once you have that diversity of emitters, you can then start to look at more commercial approaches, because if you lose one of those emitters, you don't lose all your revenue, you lose part of your revenue. So I think it's a question of the maturity of the industry at the moment on that side of things. I mean, Trailblazer is an example of where you have got diversity, and there's less support there, where there's virtually no government support in terms of volume risk, in terms of revenue security. That's a much more commercially based or commercial contract based structure, which you could see us getting to in Europe, for example, as the industry matures. Cross-chain risk is again another one of those risks which very difficult to really manage in a startup phase of an industry, because you're completely exposed to the failure of say the reservoir or the pipeline if you're an emitter, and equally if you're on the other side of that, if you can't deliver the CO2 into that system, you're left again with a stranded asset. But as the industry matures, maybe for example you had multiple stores, multiple delivery routes, you can start to then mitigate that risk through the alternative routes to manage the CO2 through the value chain. But at the moment we're in the startup phase of the industry, and it's it's those kind of challenges which are slowing the industry down. I mentioned how much support can governments give to that. If each of these projects go on the government balance sheet, there's a limit to how much government is going to be prepared to support the industry in this phase, or it is able to support the industry in this phase.
Thanks very much, Alan. And I think this theme of the maturity of the industry is really interesting, and I'd like to now turn to Pradeep so we can expand on this a bit more. The report highlights this persistent financing gap in early stage development, especially for CO2 storage appraisal and especially in emerging markets. Multilateral development banks like the ADB, development finance institutions, they're uniquely positioned to step in early, but scale remains far below what's needed. What would allow your institution or institutions like the ADB and peers to invest earlier and at a greater scale? And what barriers still limit your ability to do so?
Yeah, I think while we are an MDB, we are still fundamentally looking for many of the same things that commercial financiers look for when we finance a project. Now, having said that, we can be bolder and less conservative. Perhaps we can absorb longer development timelines. certain amount of revenue uncertainty we're able to stomach, especially when there is strong strategic alignment. And this is the kind of our risk appetite that's allowed us to finance the first of a kind projects when, especially in the large scale renewable energy space. For instance, the first cross-border wind project in Laos exporting to Vietnam. So there was a need for curtailment provisioning. And so we were able to set up an escrow fund that would then support, whenever there was a reduction in revenue because of curtailment by the import of the power. But it's again a scale issue because you're talking, if it is in the tens of millions of dollars, that is a scale that MDBs can come in and support, in terms of concessional money or in terms of grants. But if you look at the projects, CCUS, especially the ones that are described in the IEA report, we're talking hundreds of millions of dollars of public money going in. And so I think it's really, that is something that's way beyond an MDB scale. And that is where I think if we are to be trustees of large funds that are supported by developed countries, that would be workable. I think this is where I would make the case that, look, we've talked about how abatement costs are lower in Asia Pacific for various reasons. We all know that the cost of electricity is a big driver of CCS costs. When you've got renewable-based energy, which is in the 6 to 9 cents a kilowatt hour for even firm power in some of these regions, I think we need to be maybe looking to supporting CCUS projects in this region, where you got lower labor costs and so on. And so maybe that's an area where I think MDBs could actually really help to identify a few first mover projects in this region and then bring them up and then canvas them so that we can actually bring, crowd-in financing. I think just a quick, people have been talking about all the different risks, cross-chain risk, technical challenges, storage liabilities, the missing money gap. You've got carbon prices in the region between $3 to $10 per ton. And again, as the report says, and many other reports have said, you're looking at anything between $80 to $120, which actually works. If you look at the 45Q tax credit provisioning, that's at about $85. So you've got a huge missing money gap. We aren't talking a few millions here. We're talking hundreds of millions. So I think this is an area where I think commercial projects would be still a stretch. What we would hope to do is really catalyze a handful of first of a kind, even demonstration scale projects. And even that would take substantive amount of grant financing or concessional long-term loans, presumably coming from other sources, because as a bank, we don't generate those resources ourselves. Let me stop here.
Mariam, I have a question for you for insurance in particular. We describe insurance in the sector as a crucial enabler, yet we know there's already insurance products for some of the aspects that CCUS cover, but we know there's still a few gaps and challenges, particularly around long-term storage liability, cross-chain risks, how to allocate the liability across the different stakeholders. From your perspective, what innovative approaches are needed to leverage the expertise of insurers and to really unlock wider private capital thanks to insurers?
Thank you very much for this question. And indeed, my first response to Pradeep was, as you get into those first of a kind projects, call on insurers, risk engineers around the table. Typically, as you said, Mathilde, that insurance companies and reinsurance companies who actually take these risks on their balance sheet, generally are called upon, when in a very transactional way to this kind of pre-commercialization projects. So what we've been promoting and really supporting with a lot of research and development is that by bringing insurers, risk engineers, along with the project developers, investors, and governments around the table, and adopting what we call a project life cycle approach to this project, I think we can get a much better framing of the untested risks. Who are the stakeholders? What are their roles? What are their liabilities? What are their contractual agreements? What risk mitigation measures they are undertaking? Because one of the things we've found by working with industry clients is description of risk really varies across developers, governments and insurers, and we need to align that. All of that would enable better coordination to reduce the risks and to start with more innovative risk-sharing mechanisms from early stages. Part of this, the importance of doing more of a life cycle view of this, is that there are many risks that could be triggered because of cascading impacts. So as you look at insurability of risks, we can look at what actually could be insured through market-based insurance solutions, what things could become insurable based on risk mitigation measures that can be adopted by different stakeholders with different roles, and then really zoom on what's not going to be insurable through the market-based insurance market that's going to require other mechanisms, self-insurance, government guarantees, or other long-term liability transfers. So again, I emphasize that the big transformation is twofold: bring insurers, risk engineers around the projects as soon as possible from pre-commercialization stages, and adopt that project life cycle approach. And then now when we look towards commercialization, insurers, beyond just risk engineering, underwriting, obviously they play several other roles. One of those critical roles is development of standards for project replication. And if you look at, for example, offshore wind, it was the initiative of the insurance industry bringing together various stakeholders and standard setting bodies to develop risk mitigation standards for how you actually develop and replicate these projects at sea. So similarly, I think as we need to significantly enhance the way we are actually doing this risk analysis and risk sharing mechanisms from the other side, we can work together to expedite development of standards with a more holistic view spanning all those functions, so that we can bring expertise to replication of projects that can go across the world, even though we know on a region by region basis, projects could be specific. I will stop here. Thank you.
Thanks very much, Miriam. And this touches on a few of the questions that we're seeing here in the chat as well, is around risk sharing mechanisms, risk allocation. So we've seen recent projects that have reached financial close, where governments have these robust risk-sharing mechanisms, contracts for difference, regulated asset-based models. And as CCUS markets mature, I'm interested to hear each of your perspectives on which of these risks should remain with the public sector, which can eventually be transferred to the private sector. From an insurance perspective, does this matter as long as the risks are covered? And looking specifically at the UK example, we see these risk-sharing mechanisms. Can they be replicated elsewhere in different regions? Alan, I'll first start with you, and then we can move over to Miriam, and then over to...
I think I'm starting with the last question first. Can the UK risk-sharing matrix be replicated? Yes is the answer. Should it be? I'm not sure, because I think where we got to negotiating with the UK government in terms of risk support was really a feature of the UK or the European market and the type of risks that were being faced by the projects. If you translate that to situation in Asia Pacific, for example, where you have CO2 volumes probably going to be shipped around the region, where you don't have an EU ETS at the moment, or the US where you don't have an EU ETS, the risk being faced by the projects is slightly different. So you need to adapt the allocation according to which jurisdiction you're operating in. I think what the UK has done is provided a good baseline as to what risks projects are willing to take, banks are willing to take, which obviously you need to take note of and transfer into the particular jurisdiction. Where we get to in terms of risk allocation once the industry develops, I suspect at some point we're going to get to a as I said, a more commercial-based industry where a lot of the risks are taken by the private sector as the industry matures. Obviously, at the moment, we still need subsidy because we're essentially removing a waste product from the waste stream, and CO2 price or certificate prices are not at a level which really supports that at the moment. So that subsidy will stay for a while. But I think we're already seeing a push to reduce the level of risk support, to transfer more risk to the private sector, to the insurance market as well. So I think that's going to be a continuing theme as we go from project to project. I think one thing the UK government also achieved with the level of risk support they provided for the first projects is creating the infrastructure which is then available to follow-on projects to connect to. So for example, on Northern Endurance Partnership, there's a lot of emitter capacity now being developed, capture plants being developed, because that infrastructure is there. So they unlock the circularity of, we can't capture CO2 because there's nowhere to put the CO2. We can't build a transport and storage system because there is no CO2 to store. So it unlocked that circularity, and it's created I think the base for an industry to grow significantly and on a much more commercial basis.
Thanks very much.
Maybe
Alan,
I can pick up on Alan's point, which I think he hit so many critical points here. What I like to add is this is actually the subject of what we are deeply exploring right now through our initiative, because obviously the insurance industry thrives to realize opportunities. However, this is subject to number one, better understanding and mapping of risks. Secondly, availability of data to be able to price the risks. And, and thirdly, to make sure that those risks meet insurability criteria. So this is actually what we are deeply looking at. And hopefully towards the end of this year, we should have a report on what drives insurability of CCUS projects as we scale. And one of the key questions that we're talking about, at least for now conceptually, is where would private sector ends and where would government starts? And somewhere in the middle, they might be a combination of private sector and government. I just want to invite you to wait and see what we're going to come up with, because these are very complex questions and require deep analysis, but certainly an area that is of deep interest to the insurance industry. And we are looking to support it more strategically as opposed to what it has been up to now, more transactional. So stay tuned.
Yeah, I think if I could just, again, my panelists have said a lot, and just a few additional points, I think, is really, it's risk allocation 101, right? You want to allocate risks to entities that are best placed to manage them. And I think we all agree that absent a mature carbon market at the levels we need for these projects to move ahead, or binding demand side mandates, public sector is going to remain critical to underpinning project revenues and providing confidence over the long term. And that's the only way, so the public sector is best placed to take on that. When it comes to, I think, especially again in the Asia Pacific, what we found during our early decade or so work on this is that while there is a lot of data on geological storage and sinks and all of that, most of this data sits, it's not non-digitized, it's sitting with large state-owned enterprises, and it's really difficult to get this data out. So this is another area, I think, where the governments can take the lead, either by themselves or regionally, and actually carry out a comprehensive geological study in sink mapping and making this information available in a transparent and harmonized way so that we can actually begin to understand the potential. And this helps with project development as well. One of the first efforts we actually put ahead is that ADB financed a coal integrated gasification combined cycle plant in PRC. And the idea is that we would use grant financing to pilot a certain amount of CO2 injection in a nearby gas field. or we just couldn't get these two entities to talk to each other and share data and come to a point where the project will move ahead. So this is back in 2012. So it's a good example. I mean, somebody else mentioned about different entities with different cultures, different sort of backgrounds who've never had to work with each other having to do this. And so there's a lot of learning there, leapfrogging that we can do. We don't have to go through all the same mistakes again. I think that's one thing I really want to mention. But I think, look, we have a lot of experience with large infrastructure projects. So I think construction, completion, routine operational risks, these are all things that the private sector can be expected to take on. Because I think we all agree that CCUS is really about integration. It is not about GVIS new technology. I mean, the capture piece, the transport piece, the injection sequestration is all individually well understood. It's been done at scale. It's been done for decades. And I mean, again, I'm talking about amine solvents and things like that, and not all the advanced scrubbers and things that are coming up. But I think a lot of this has been done at scale. I think commercial banks and MDBs are quite comfortable understanding that it's really the integration of this and then the revenue risks that are really the hardest, and sort of any policy backstepping or U-turns that may happen that might then again impinge on long-term revenue. I'll stop here. Thanks.
Thanks, Pradeep, for that. And I was about ready to close out the session, but you hit a buzzword that we hear a lot at the IEA, and that's data. So I have one more question for the rest of you panelists here. And that's, we talked about the need for early collaboration, the need for data transparency, as Dr. Prajadi mentioned. The IEA, we have our own CCUS projects database, which provides some transparency to the sector. This is just one slice of the overall pie of data that I assume institutions need. So from your perspectives, and we'll start with Miriam and then move over to Alan, what specific data, whether technical, regulatory, financial, operational, would have the biggest impact within your area in de-risking CCUS projects?
I would say all of the above. I just want to go to Pradeep and say, you nailed it with what you said. There is so much data available. However, pulling together this data and pulling them consistently per standards so that they can properly be used for risk assessment for all different areas of risk is foundational. Also, as part of our numerous technical workshops, what we found is significant amount of work, again, has been done by geological surveys of various governments and so on. Yet the issue, again, becomes data inconsistency. So one thing that I would like to share, that in all these discussions, insurance always is an afterthought, whereas the experience of insurance industry in terms of, even in the most competitive environment, finding ways of share data for the greater good of the industry to be able to underwrite better and more can be leveraged in these areas. So I can only say that, pertaining to various areas of risk, engaging insurers in risk engineering expertise in your projects much earlier, and also as part of these initiatives where we want to really mine a lot of that data and make it consistent, is going to bring significant amount of benefits. Pradeep, you mentioned that we understand this, we understand that, banks have done it, whatever. Well, you haven't included insurers. So let's get down to business and bring them around the table and help them expedite with that process so that they are the ones that do the best risk management and risk engineering so that they can do the job that they're designed to do, managing those risks to the extent that they can.
I tend to agree that it's all of the above.
Alan, over to you.
Yeah, as I say, I tend to agree it's all of the above, because I think for us, the industry of financing runs on precedent. So the more successful implementation we see of carbon capture, the more data we get coming back on construction, on the operating phase of CCS, the better we're going to be able to assess the risk, and the less conservative the base cases are going to be. Because at the moment, when we see a risk that we can't necessarily find a precedent for, and we're being expected to take. We either take conservative assumptions on how that risk is going to play out, or we include contingencies in the base case, which all impacts on how much debt someone can raise and the cost of that debt. So, that precedent gives us an ability to be more optimistic in base cases to improve the financing costs and reduce the overall cost of the financing to the projects. And we saw that in offshore wind. At the beginning of the offshore wind, banks took a very pessimistic approach. As experience fed through, the banks got more comfortable, more confident, and were able to take a much more positive approach on the assumptions.
Yeah, and I think if I could add, I think Mariam, we banks, we love insurers,
I know
and I
you
think
do.
we couldn't work without you guys. And I think again, really, gone are the days when you look at an infrastructure project, a fully wrapped EPC contract with a nice insurance package would be ideal. But those are not
Ideal.
they're looking at in a CCUS context. You're really looking at, I really appreciate what you said about getting them early on in the discussion, identifying issues, and then sort of really looking at, life cycle based analysis. Because 100 things can go wrong. You're really sort of bringing three different things together and multiplying all of those little risks. None of this, again, it's not a high risk technology bet that we're looking at with CCUS. It's really a complex infrastructure and policy anchored investment that needs to pay back over decades and potentially as liabilities that goes into a millennia, right? So this is a classic problem for insurers.
And again, if I can just add, we cannot begin to emphasize the need for development of carbon markets that can also, we've spoken to many sectors beyond oil and gas that rely on CCS for reduction of a big portion of their CO2. And by enabling carbon markets, we can start fueling funding into that project. So viability of technology-based carbon markets cannot be stressed. And again, that is where insurers could come in.
Thank you. All very interesting points. I feel cautiously optimistic about the sector despite the complexity. There's a lot of interest, and it sounds like there's a need to get these stakeholders at a table early on. For those who are financing or developing projects, get Mariam to the table, get Mariam's insurers to the table.
Mariam's members to the table.
Over to Dr. Gul here, who will conclude our remarks.
Yeah, thank you, Carl, and thanks indeed to our three distinguished panelists for this very rich discussion and the very, aligned and harmonious view of the finance industry on this particular topic. It tells you that on the one hand there is an important place for that industry, goes without saying in many ways. A lot of untapped potential here, I think, between the energy sector and the industry, finance industry, to work together on this particular technology and its very individual specifics. So really big thanks to all the three of you for being with us today, to you, Mariam, in particular at this time of the day, I should say, and Pradeep from where he's sitting on a public holiday. To all the three of you, really big thanks for making this discussion. Of course, to everyone who was on this webinar today and all the many questions that we've received. I think we covered a lot of ground of that, but I'm sure there's a lot of space to discuss that further. I'm pretty sure our three panelists would have liked as much as we do to engage even further on this topic. But in closing, really big thanks to Mathilde Fajardi and Carl Greenfield for this particular report, for setting up today's webinar. I hope everyone on the call enjoyed it as much as I think all the six of us did. And you will find an upload of this video on our YouTube channel, on our website in the near future. So thank you very much for being with us today. Please don't hesitate to look at the report at our CCUS project database and stay tuned for more. Thank you.
Thank you.
Thank you.
Thank you very much.